Welcome to the October edition of the Equity Markets Movement. On 18 September 2024, the Federal Reserve Fed made a significant move by reducing its key benchmark Fed fund rates by 50 basis points, lowering it to a range of 4.75 to 5%. According to the updated dot plot, the Fed anticipates the Fed fund rate to reach 4.4% by the end of 2024, which could signal two additional rate cuts of 25 basis points each on 7 November and 18 December. The dot plot also indicates the possibility of another percentage point cut in 2025. Historical data suggests that equities market tend to perform well following rate cuts as long as a recession is avoided and the US experiences a smooth economic transition. As the rate cuts continue, money market may become less attractive over time and potentially shift towards riskier assets in search of higher yields and returns. The supportive stand of the Fed, combined with the resilience of the US economy, provide a favorable backdrop for both equities and bonds. Throughout most of 2024, it seems that market sentiment has been influenced by interest rate. There are several other factors at play, apart from the interest rate theme. Between June to August 2024, the S&P 500 saw a decline of over 8%. Nevertheless, selling pressure was well absorbed as S&P 500 companies increased their shares buyback. In the second quarter of 2024, the year-on-year growth in shares buyback surged by 34%. Looking specifically at the quarter, the top 10 US stocks, including Apple, Alphabet, and Microsoft, control over one-third of the US $2.5 trillion in cash and investment held by the S&P 500 in May 2024. This, coupled with a significant amount of investment liquidity on the sidelines, with the US money market funds reaching a record high of $6.3 trillion, would potentially provide support for the equities market. As we approach the third quarter corporate earnings season in the US, the estimated earnings growth rate for the S&P 500 is currently projected at 4.9%, making the fifth consecutive quarter of year-on-year earnings growth, but it is worth noting that this growth rate has been revised downward from 7.8% since June 2024. Looking ahead to the US presidential election on 5th November, there is currently no clear winner between candidates Kamala Harris and Donald Trump. If Trump is re-elected, the Federal Reserve may pause interest rate cut due to potential inflation from its trade tariffs, immigration policy, and tax cut. Traditional energy companies, especially those in oil and natural gas, would benefit from his commitment to reducing restriction on domestic oil production. Defense stocks are also expected to perform well under a Republican win, as defense spending would be a top priority. On the other hand, if Vice President Harris wins, there would be policy continuity and reduced uncertainty, potentially leaving the Federal Reserve to lower interest rates further in 2025. Harris' victory would have a positive impact on clean energy industry like the renewable energy companies, electric vehicle manufacturers, and utilities. One advantage of Harris' administration is the belief that she could avoid a trade war with China, unlike Trump's aggressive approach to trade and tariff. Historical data indicates that regardless of the occupant of the White House, equities generally experience an upward trend. Looking at the S&P 500 average annual price return since 1945, it shows an 11% gain under the Democratic administration and 7% under the Republican administrations. The technical outlook of the market remains unchanged since September. The S&P 500 is expected to face potential resistance between the level of 5,007 and 5,008. Any price decline would offer an opportunity for value investors to find attractive investment. As for the Hong Kong Hang Seng Index, cautious buying signals emerged in September. A supportive base is forming around 17,002 in the near term, and the index is attempting to trade higher, supported by the key 50, 100 and 200-day moving averages. The various policy unleashed by the Chinese authority on the 24th of September, cutting short-term interest rate, boosting banks lending to consumer and corporates, does help the market sentiment. But how far the index can scale up will depend on how effective the policies to be stimulating the economy.